Welcome back to The Explainer. Today we're diving headfirst into the massive S&P 500 Q1 2026 earnings report. If you've been tracking the markets lately, you already know there's a huge, dominant narrative taking over right now. But today, we're going to peel back the layers of this data to see what's actually driving the market beneath the surface. We're moving way past the headlines, looking at the raw numbers to figure out the true state of corporate America.
Here's the roadmap for today. We're going to cover the Q1 earnings smash, the heavy lifters doing all the work, the real winners, losers, and sectors, the valuations and hidden risks, and finally, our final verdict.
All right, let's kick things off with part one, the Q1 earnings smash.
Look, the surface-level celebration going on right now, it is totally justified. The S&P 500 just absolutely crushed expectations with a staggering 27.7% year-over-year earnings growth rate. I mean, to really put that into perspective, right at the end of the quarter, analysts were bracing for just a 13.1% growth rate. That is a massive, market-moving upward revision. It tells us point-blank that corporate earnings momentum is undeniably strong and absolutely robust enough to support this broader equity rally we've been watching.
Let's look at the actual scorecard. With about 89% of S&P 500 companies having reported, we're looking at an 84% earnings per share beat rate. But honestly, look right below that, an 80% revenue beat rate. So why does this matter so much? Because it proves this isn't just some low expectation season, right? Companies aren't just magically finding profit by slashing costs or playing financial engineering games. Top-line revenue and sales are genuinely healthy. People and businesses are actually out there spending.
Moving right along to part two, the heavy lifters.
But here's the catch. The index level only tells half the story. When we start peeling back this earnings onion, we hit a really critical truth. This massive growth, it's not a team effort, not at all. The earnings momentum we were just celebrating is super concentrated in a very select, insanely powerful group of megacap companies. We are talking about the giants dominating AI, cloud infrastructure, digital ads, and semiconductors, specifically Alphabet, NVIDIA, Amazon, Meta Platforms, and Micron. These are our heavy lifters. They're doing a vastly disproportionate amount of the work lifting the entire S&P 500's aggregate earnings growth rate.
And honestly, it's staggering just how heavy that lifting actually is. Get this, during one major revision week this season, just 3 companies, Alphabet, Amazon, and Meta, accounted for roughly 71% of the net dollar-level increase in earnings revisions. The other 497 companies in the S&P 500, they made up the remaining 29%. That is just a wild level of concentration.
Now hold on, it's absolutely crucial we interpret that 71% correctly, because it's super easy to misunderstand. Alphabet, Amazon, and Meta did not drive 71% of the total 27.7% growth. Actually, it's more like this. During a specific reporting window, the overall S&P 500 growth estimate jumped from 15.0% to 27.1%. That's a huge gain of 12.1 percentage points. Those 3 companies alone contributed 8.6 percentage points to that sharp upward revision. They were the absolute dominant engines when expectations shifted into overdrive.
Which brings us to part three, winners, losers, and sectors.
To really wrap our heads around this concentration risk, let's look under the hood. Take communication services. On the surface, the sector looks like it's booming, posting a massive 48.8% growth rate. But if you simply remove Alphabet and Meta from the equation, the entire sector actually shrinks by 4.6%. The underlying breadth here is incredibly weak. Alphabet and Meta are literally single-handedly dragging this entire sector into the green.
Let's jump over to the next sector and see how this plays out in information technology. It's boasting an unbelievable 50.7% overall earnings growth rate. But pull out the AI semiconductor giants NVIDIA and Micron, and that growth drops nearly in half to 28.5%. Now, to be fair, 28.5% is still an incredibly healthy number, proving tech is broadly strong. But it clearly illustrates that AI infrastructure and high-bandwidth memory are the rocket fuel driving these extremes.
And you guessed it, consumer discretionary follows the exact same pattern. We're seeing an impressive 39.7% overall growth. But if we exclude Amazon, specifically looking at their AWS cloud growth and retail margin improvements, the sector's growth drops down to a much more modest 14.9%. The big takeaway here, if you are investing in these sectors, you are heavily relying on the execution of just 1 or 2 massive companies.
So, what about the rest of the market? Well, it's kind of a mixed bag. Financials and industrials are actually offering some really constructive breadth, mostly driven by trading revenues, infrastructure spending, and resilient net interest income. Materials are providing decent cyclical support too. But then we have healthcare. Healthcare stands out as the notable laggard right now. It's the weakest major earnings area, actually showing a year-over-year earnings decline, completely missing out on this platform and AI-driven boom.
Let's pivot to part 4, valuations and hidden risks.
With the heavy lifters doing so much of the work, we have to ask ourselves, what could possibly go wrong? Well, the simple truth is the S&P 500 is not cheap right now. It's currently trading at a forward 12-month price-to-earnings ratio of around 21.0x. That is sitting well above both the 5-year and 10-year historical averages. What this elevated multiple means for you is that the market is already pricing in a ton of good news. The margin for error here? It's razor thin.
This whole dynamic creates a massive tug-of-war in the market. On one side, the bulls are arguing that this 21.0x multiple is totally justified by the incredible EPS growth, the seemingly unquenchable thirst for AI, and the resilient profit margins we just talked about. But on the flip side, the bears are staring at the exact same data and sounding the alarm. They are warning that sticky inflation, rising treasury yields, super narrow market breadth, and the risk of margins compressing make this entire market look a bit like a house of cards.
Speaking of profit margins, they are absolutely the key focus here. Right now, operating leverage and cost discipline are making margins look fantastic, but they're facing some serious forward-looking threats. Labor costs, wage inflation, potential tariffs, and supply chain snags, those are constant pressures. But honestly, perhaps the biggest hidden risk is the massive capital expenditure. We're talking about the huge CapEx burden required to build out all this AI infrastructure. If these companies don't start showing massive returns on those multi-billion-dollar AI investments soon, those margins are going to evaporate.
And that brings us to our final section, Part 5, the final verdict. Taking all of this deeply contrasting data, the brilliant headline numbers, the heavy reliance on those tech titans, and the premium price tag, where does that actually leave us? Well, based on the raw data, the Q1 2026 earnings season earns a solid A rating. It is a fantastic quarter, for sure. It misses out on the A+ purely because the growth is just so narrow, and current valuations leave incredibly little room for disappointment. Right now, companies that miss their targets are getting punished severely by the market. You can see this reflected so clearly in the investment sentiment ratings. Mega cap tech remains highly bullish, scoring a 4.4 out of 5, and communication services is right behind at 4.1. Even consumer discretionary is sitting at a 3.7, though heavily reliant on Amazon. But contrast that sharply with the rest of the market. Healthcare is lagging way behind at a really pessimistic 2.7.
So if you're actively trading the S&P 500, what are the practical takeaways here? First, the data tells us to maintain a constructive bias. The earnings are definitely there to support the broader market. This translates into a classic buy-the-dip environment. However, extreme caution is absolutely required when it comes to step 3. Avoid chasing extended upside. With a 21x PE ratio, buying at the absolute top of a rally carries some serious risk. And finally, you have got to monitor megacap leadership closer than ever before. Because as we've seen today, as they go, so goes the market. Which leaves us with this final, crucial question to ponder as we look toward the rest of the year. The AI titans are clearly carrying the market today, generating historic growth and basically masking the weakness in other sectors. But what happens to this market when the heavy lifters finally need to take a rest? Thanks so much for joining me for this explainer. Keep your eyes on the data, and we'll see you next time.